In today's video, the first of the channel and the first of this planned series, we are going to be discussing a key idea in the stock market. While the future of the stock market is not guaranteed by the past, it is often found that the future reflects the past. Today's video will focus on a well-researched strategy that also makes logical sense, two things which you should always see in any strategy you employ in the stock market. I'll cover some reasons as to why you should consider using this strategy, and I will also explain why it works.
Firstly, the future has a history of reflecting the past. This graph shows us when bear markets and recessions have occurred in the US economy. We can then look at the performance of the S&P 500 versus the performance of Berkshire Hathaway, the stock I will be recommending in this video. Before I show you this though, I just want to ease everyone's concerns about the market volatility with the following graph. As you can see, prior bear markets have resulted in small losses relative to the overall improvement to the stock market through the bull run. This is due to an increase in productivity growth year over year, which has always been positive in the past and is likely going to continue increasing in the future. Now, let's take a look at the three famous value investors and assess their performance versus the S&P 500 in 5-year increments after a bear market has taken place. As you can see, each portfolio manager outperforms the broader market after a bear market has taken place, except for the one exception in 1956 to 1961. But just looking at the past isn't enough. We need to understand why this is the case and if it's likely to repeat itself with Berkshire this time around. First, based on simple mathematics, mutual funds or investment funds end up trading at a discount on a price per share basis relative to their net asset value, or NAV, per share. The net asset value is the value of the underlying assets of a fund or holding company after accounting for the liabilities tied to those assets. This typically happens in bear markets because people panic and are willing to sell their shares at a loss relative to their net asset value because they want to get out of the market. This results in a severe mispricing of funds. Berkshire does not fit this definition perfectly, given that it's not a mutual fund like the Magellan Fund that Peter Lynch ran. However, it still owns a variety of businesses, and given that the underlying assets of these businesses haven't been damaged into perpetuity, the shares are likely trading at a discount to their net asset value. Second, value investors, and particularly the most successful one in history, Warren Buffett, keep a wish list of stocks. A wish list is a collection of companies that the value investor has analyzed and loved, but the investor does not open a position just yet because the price wasn't right. However, in times like this, Buffett will pull that wish list out, take a quick look at the companies again to check if the fundamentals are still okay, given the economic turmoil, and then if the company has not changed fundamentally, he will go out and buy these companies at a discount to obtain his margin of safety. The margin of safety is a concept value investors use to protect themselves against investment risks they may have missed, or to protect themselves against any inaccuracies in their free cash flow forecasts. Note, this is very different than just dollar cost averaging down on a position. For example, Buffett owns Suncor, an energy company, but given the OPEC issues causing a steep decline in the price, Buffett may not be willing to add shares to this company just yet. However, Apple, a company which is not as heavily impacted at this time, might be a company Buffett would be willing to add to at this time. This leads me to the final benefit of buying Berkshire at this time. Right now, you might be looking at your portfolio or other stocks that you may have analyzed and might be kicking yourself for not having enough cash on hand to take advantage of all these opportunities. However, Berkshire does not have this problem right now. Buffett was sitting on a massive amount of cash, 120 billion plus. There is a reason value investors underperform the market in the latter years of a bull market. Things are just too expensive and the value investors can't find their margin of safety. However, this certainly won't be the case for Berkshire's wish list now, and we could definitely see strong outperformance for Berkshire in the years to come as he and his team add to incredible companies at incredible prices. Finally, if you don't believe this advice coming from me, maybe you'll believe this information coming from a very successful hedge fund manager, Miss Laura Templeton, Sir John Templeton's great niece.
So, you've got Buffett from 65 to 2011 has annualized 19.8% versus 19.4% for the S&P 500. Peter Lynch from 77 to 90, annualizing 29% versus 15.5% for the S&P 500. And Sir John from 54 to 92, annualizing 14.5% versus 11.6% for the S&P 500. You can argue about these returns. Buffett's includes the early days of the Berkshire partnership. Magellan, Peter's returns includes the first 4 years of Magellan when it was closed to outside investors. I think there's some remarkable things about this slide. Number one is that Peter Lynch and Sir John Templeton both manage mutual funds. These are not easy products to manage. People are always giving you money at the wrong time and always taking it away at the wrong time. So Buffett definitely had an advantage in the structure of his investment vehicle. Also, Peter Lynch conducted a study, and he wanted to know what the average Magellan investor had earned over that time period. And he found that the average investor returned 5% or less, and many actually lost money. So the only way that could have happened is if people invested after the manager had had a big run up and sold after they drew down. Now, what's a really easy strategy that you could have run from home in your pajamas, sitting on your sofa, and beaten all of these guys? You could have bought their funds when they drew down. Mathematically, you would have had a higher return. So that's something to remember. I think, a lot of times we complicate finance, but sometimes just finding a great manager that has a value investing discipline and allocating capital to them, especially when they're down, can be a very good strategy.
Essentially, what Laura is saying here is that the average person is fearful when they should be greedy and are bad at trusting even the best investors of all time. The average Magellan investor only achieved a 5% return when Lynch had an annualized return of near 30%. This means that most investors were buying into a fund after seeing the manager post amazing returns, but then selling at times like today when the market had fallen sharply. Further, if they did come back to the fund, they likely didn't get back into the fund until the fund manager posted those great returns we saw earlier right after the bear market concluded. This is why combining the concepts of dollar cost averaging and focusing on time in the market versus timing the market is very powerful, and I'll cover it in another video. The main point she ends with is by showcasing an easy way to outperform even the best investors of all time. In layman's terms, give the star performer money when people are taking it away and selling their stakes in these firms for 80 cents on the dollar, like right now. So, I hope you've learned something today, and I hope you take some time to collect your own thoughts, review the evidence, and come to a decision about this strategy for yourself. Just a quick reminder, I may have studied at business school, but this is not financial advice, and I'm not a registered financial advisor. This channel and these videos are for your entertainment and for you to act upon based on your own thoughts and analysis. Before ending this video, I just wanted to say a few things to people to calm their nerves. Now is not the time to worry about your stock investments and to rush to sell them. You would not go to a grocery store one day, be willing to pay $8 for a pound of wings, but then the next day fear to buy that exact same pound of wings if the price had fallen to $5 per pound. I'll detail in my next video why I and many other investors with a detailed understanding of security analysis and financial mathematics are not as worried about market downturns as the average public. However, there is one thing I and many other people should be concerned about, and that's your family and friends. Offering a helping hand to an elderly neighbor, a grandparent, or anyone who may need it right now will pay a higher dividend than any stock will that you can get in the stock market right now, even at these prices. So if you enjoyed the video, please drop a like down below or a dislike if you didn't, and be sure to let me know why, as I'm definitely looking to improve. Also, share the video with a friend who you think may need to hear this, and drop your thoughts down below and I'll reply to you as soon as I can. Let me know what you've bought so far and if you're going to be thinking about adding some Berkshire to your portfolio. Just a quick reminder here for anyone new to the market or new to Berkshire. Berkshire has two classes of shares, an A class that trades well into the hundreds of thousands of dollars, and a B class that trades for around $200 that 21-year-olds like me can actually afford to buy. Take care, everyone, and remember to always be eager to learn, willing to invest, and prepare yourself for success. Thanks. Take care.